Hello, everyone, and welcome to the second quarter of 2022. While we send out many articles, I record several podcasts, and we even hold live events and webinars from time to time. And really, while I love taking super complex financial planning, retirement planning, estate planning, and other consultative issues, solving them and making those solutions easy to understand, I have to be honest, there's another big part of me, and some of you already know this, but there's another big part of me that is truly in love with the markets. Now, it hasn't been the best year in the world. Really, it hasn't been the best, call it 12 plus months, maybe even 14 months in the world here. But every quarter, I look forward to recording this video. I know some of you who love it, but I've also heard from some of you who, and I truly appreciate your honesty, but some of you have told me that you hate these videos, that they're too technical, too nerdy, and if I never recorded another one again, that you wouldn't have to waste another 2 to 3 minutes of your life figuring out that you're just going to hit stop, close your window, and delete the notification anyway. But with all that being said, it's a little late tonight. I'm starting this recording at 11:11, which, by the way, I don't know if you know this, but 11:11, catching the clock on 11:11, which you can do twice a day, of course, is good luck. I don't know what that means for me. I don't know what that means for you watching this video, and I don't know what that means for the market, but I just caught the clock as I looked up at my screen here saying 11:11. And by the way, you can't set your alarm every day so you can see 11:11. You have to see it by total chance, otherwise it doesn't count. But anyway, with all that being said, let's get into a bunch of super interesting details about the market, and that's not just about the stock market, by the way. I've got research from friends of mine that I'm including as usual: U.S. stocks, international stocks, bonds, commodities, fund flows, asset class rankings, breadth and participation, the trade deficit, mortgage rates, and even home prices today. So let's get into them all. Now remember, this is only available on YouTube, so make sure you hit that gear button on YouTube, set your YouTube player to the highest possible resolution so that you can see everything with the best quality video possible. If you don't, sometimes it can get a little fuzzy and hard to see, but also if I'm going too fast, hit that pause button and rewind, or you can hit the left and right arrow keys on your keyboard if you're in full screen presentation mode. I'm not sure if you know this, but if you're in full screen mode, you can hit the left or right arrow keys on your keyboard to jump forward or backward 5 to 10 seconds. And if you're watching on your phone and you turn it on its side, so if you turn your phone on its side, you'll get a better, bigger view, and you can also double tap with your finger on the left or right side of the screen to get that same fast forward or rewind function. So, all right. That's enough housekeeping. Let's go ahead and get into the quote of the day as usual. Today's quote of the day, really important. Daniel Kahneman, he said, "The brains of humans contain a mechanism that is designed to give priority to bad news." And I think that's so important because for a couple reasons. One, most people don't know that the stock market, we'll just say, has an upward bias. That means that roughly, and then this isn't perfect, but roughly 3 out of 4 times, or we'll call it 75% of the time, the stock market goes up. It's that 1 out of 4 times that's tough and things get really bad. Now, it doesn't happen, obviously, literally every 4 years. It can be, every 7 years over a certain period of time is one subsample that some use. You could say that the market started a new bull market after COVID. Since the market went down 34% in 22 days. Some look back at 2018, the fourth quarter, when the market went down almost 20% in about 59 days. That was the beginning or the end of the last bear market, beginning of the next bull market. Some people look back to 2015-16, when the market went absolutely nowhere, but generally down or with a sideways bias. We'll call it trendless for 20 months, so almost 2 years. The market went absolutely nowhere. So kind of a crazy time, but you could some even go all the way back to 2009 at the bottom of the last big, long, grinding bear market. And I think the reason why some people do that is because, and if I'm being honest, I'm kind of in that camp. I know I might catch a little bit of shade from my good friends in the technical analysis community for saying that. But everybody has their own time frame, and I understand that 2011 we had that 20% decline due to the U.S. Treasury downgrade, and we could have had to reset that. I realized that. I realized that we had a bear market in international equities in 2015-16, even though the market here in the U.S. only went down between 12 and 15% twice and went absolutely nowhere in that almost 2-year period. I realized that you could say there was a bear market in international equities. I also realized that the fourth quarter of 2018 was a bad quarter. Again, 59 days, market goes down almost 20%. And then you have COVID, where the market goes down again 34% in 22 days. But here's my issue. Here's my issue with considering any of those time periods the beginning of new bull markets, or the end of a bear market for that matter. My problem with it is that in any of those instances, the market came back after each drop. Call it correction, call it crash, whatever you want to call it. The market came back in roughly 3 to 4 months later. Now, you might go back to 2015-16 and say, whoa, wait a minute. You said the market went nowhere for 20 months, and it didn't. It went for 20 months. It went absolutely nowhere. Again, with a downward bias, really, but trendless, sideways. And but when you look at 2015, when the market kind of peaked in May of 2015, and it went down, it was mild. I mean, it was a mild correction. It wasn't anything to be freaked out about, and really not many people did freak out. And when it came back, which it did between, I think if I remember correctly, it was September, October-ish, and peaked again before going down again in November, December of 2015 into 2016. It went up, it went down, I think 14.6% if I remember correctly in the fourth quarter into the first quarter of 2017 before the market just had a really, really low volatile year that year. But anyway, it was still a situation where the market went down and came back almost to even. We'll call it almost to those all-time highs. Not quite, but almost. And so the reason I have trouble calling all these different drops in the markets, the beginning, we'll start with the end of a bear market and the beginning of a bull market, is because we really haven't seen anything that's been long, grueling, and just terrible for our psyche since 2007, 8, and 9, and before that, obviously 2001, or 2000, 2001, 2002. And maybe the reason for that, this last 13 years being as, call it disgusting and difficult as it has been with, big, short, but fast market drops and declines and rebounds, is the fact that we had 2 big, huge, catastrophic crashes between the longest drop since the Great Depression in 2000, 2001, 2002, and then the deepest, and being the Great Recession or the mortgage crisis, whatever you want to call it, between 2007, 8, and 9. But anyway, I'm on a huge tangent right now, so I'm going to go back to our quote here. So again, Daniel Kahneman said, again, professor of psychology at Princeton University, the brains of humans contain a mechanism that is designed to give priority bad news. And the reason I bring that up, or the reason I use that quote today, is because I know that there's a lot of people out there, and I've talked to a few, quite a few, just in the last couple of years, who are just worried that they're going to buy or invest their money toward the top of the market before it drops. And so they wait, or they want to be cautious, which is understandable, by the way, completely understandable. But then they wait for that market drop to happen, which, for instance, we just had, a 15%, more than a 15% market pullback or correction in the S&P 500, and more than a 20% drop in the NASDAQ this year already. But when that drop happens, those same people say, well, you know what, I'm going to wait for things to get better first, or I'm going to wait for the conflict to subside in Russia, or I'm going to wait until this trade deficit gets better. Or, in other words, there's always something, and we call it the stock market climbing the wall of worry. There's always going to be something that wants to keep you from investing your money. And I think the big lesson, and I'm not going to get into this, by the way, the reason I'm saying all this now is because we're not going to talk about it the rest of this presentation. All we're going to do is get into a bunch of charts and data, and I'm going to give you a really, really unbiased I want to call it a snapshot, but an unbiased, several pictures of the market in different ways, and we can kind of judge the evidence for ourselves. But I guess what I want to say before we get into the details here is that we have to ask ourselves, this money that we're putting to work, or not for that matter, when are we going to use it? When are we going to when are we going to spend the money? And I think that might help us a lot when it comes to determining the best time to invest our money. I'll give you two quick stories. One, we have somebody we spoke to in the last 2 years who sold everything they owned in the stock market way back in 2009. 2009. That's a long time ago, 13 years ago. And they never invested it. It's been sitting in cash the entire time since then. And that's sad. And it's sad because 13 years is more than half of my career. I've been doing this for almost 21 years. And while this last few years has not been good, or at least it's been difficult, we'll say, it's 13 years. I mean, it's a lot of growth to miss out on. It's a lot of opportunity cost that was missed. So that's the first thing. The second story is just we have quite a few people these days who are just convinced that the market is going to collapse as a result of all the things that are going on in the world today. And the problem is, I could give you a chart, or I could show you a chart, and I don't have it up today, maybe I should have, that could give you, over the last 15 years, I could give you 50 reasons why you should not have invested your money. But the point is not that it actually proves you shouldn't have invested your money. It's emotional reasons why you shouldn't have invested your money, but you really should have anyway, and you should have ignored your emotions. So, Daniel Kahneman, he has 2 degrees, one in psychology, one in economics. He's a PhD in psychology, though. And me personally, I went to Ohio State University, and I have 2 degrees, one in finance, one in psychology. And I always joke that I use the psychology degree more than I do the finance degree sometimes, but it seems that way anyway. But the Daniel Kahneman spent all of his time, or most of his time, researching the psychology of decision making in humans. And again, we are biased to the negative. And unfortunately, whether it be our cell phones, Facebook, news feeds, those little banners that pop up on our phone, the radio on the way to or from work, the radio on Saturday morning when we're listening to our weekend radio, the TV that we watch, whether, I don't care if you're watching MSNBC, CNBC, or Fox News or CNN, I don't care. It's all pointed at getting you to watch more news. And they're not going to get you to watch more news by making you happy. Because if they make you happy and they make you feel good, then you're just going to go outside, relax, enjoy the warm weather that's coming up here anyway in Ohio, spend time with your family, read books, have fun, and really do all the things you should be doing anyway. But you don't, or at least you spend a percentage of your time worrying about the negative that's going on in the world and the things that might happen, that most of which just don't happen. I was showing my boys this morning, and I'll shut up in a second here, we'll get into the charts, but I was just showing my boys this weekend because my wife's out of town for the whole week, and I've got the boys all week long, and we're having a lot of father-son fun time. But we were watching a Simon Sinek video, and Simon says in this video, and he's an author in case you don't know, that he wrote Start With Why and several other great books, but he talks about how people are wired, the brain is wired, where more than 50% of our thoughts are negative. Well, more than 50% of our thoughts are negative. Another book I was reading, Mark Sisson, he's kind of more of a paleo and nutrition guy, but he talks a lot about how all of most of our thoughts are negative. We're always thinking negative thoughts, whether those negative thoughts are about the world, where we live, our money, our fitness, the food we eat, how we feel about ourselves. It's mostly negative. And so the last thing I think we need to be doing is looking at financial news and finding another reason to get scared or get worried. So I know that was a really long intro, and I apologize because we're already almost 15 minutes in here. So hopefully some of you are still with me, because this is going to be a really good clipboard here, but I'm going to go fast, especially because I talked so much to start. So let's go. Jumping into the material here, we're going to start first with U.S. monthly rent. I just thought this was interesting. When you go back to December of 2020, which is not too long ago, obviously, the average rent in the U.S. was $1,111 per month. And since then, average rent is up 17%, more than 17%, to $1,333 per month. Now, along those same lines, homes are up in value, and not by a little bit, by the way, because when you look back to the peak of the real estate market back in 2006, 2007, the Case-Shiller index, which measures the price of homes, went down 27%. So in other words, the average home value in the U.S. went down 27%, which is a big loss, obviously. Many of you know this because it hurt your pocket personally. I can tell you personally, I owned a condo that Donna and I bought. We lived in it before we had kids. We owned it for about 10 years, and it took 10 years to sell it. And when we sold it, we purchased it for $186,000 in a really nice area, by the way. And we ended up selling it for $142,000, I think. So took a big loss on that, and we sold it a few years ago. But maybe we should have held on. Who knows? But anyway, it doesn't matter. Nobody can predict the future. But anyway, since the bottom of the market, which we could call January of 2012, the national prices for homes are up 110%, which is nuts. We're talking a 10-year period where homes have more than doubled. Now, while homes have more than doubled in the past 10 years, when we look at the short term, home builders have done very well. But more recently, we're starting to see home building stocks really struggle. So real estate stocks are still doing pretty well. They're kind of chopping sideways, but home building stocks are not doing so well. We can see here on my screen, they're down 28%. This is XHB. It's the S&P Home Builders Index, or Home Builders ETF. But if we look at mortgages, this might tell a story as to why those home builders are struggling. Because from 2018, December, through January of 2021, we saw a huge decline, almost a 50% decline, call it 40% decline in interest rates, or the 30-year mortgage rate. Now, since then, we've seen it jump to more than where it was in December of 18. So just this past week, mortgage rates, 30-year mortgage rates, sitting around 4.67%, which is going to put some downside pressure, or at least it's going to cause a pause for some people in some people's minds on whether or not they want to build or buy real estate. Now, with that being said, by the way, the national average is much higher than 4.6. So I don't think this is that big of a deal, to be honest. But it does, when people are used to these ridiculously low rates this last couple of years, everything's relative. And of course, it feels like it's a lot worse than it was. And speaking of a lot worse than it was, the U.S. trade deficit is higher than it's been since I was in high school. And that puts things into perspective. So the annual U.S. trade deficit now is up at almost $90 billion, which is a lot. So that's not so good from an economic standpoint anyhow. But with that all being said, and even though we had a really, really bad first quarter of the year, the market, like I mentioned earlier, the stock market, we'll say the S&P 500 was down more than 15% at one point. The NASDAQ was down more than 20% at one point. At the end of the quarter, end of March, the S&P was down almost 5% to close the quarter. And when we look back at past midterm election years, when and only when the first quarter in the market was down, you can see how things panned out the rest of the year. So for FDR, in his second term, even though the first quarter was down almost 20%, the second quarter was up 36%, third quarter up 6%, fourth quarter up 8%, and the year ended up 25%. So the year started down almost 20%. It ended up 25. That's pretty phenomenal. When we look at FDR's third term in office, first quarter the market was down 7.8, but it finished the year up 12.4 after 3 consecutive positive quarters. JFK, he had the Cuban Missile Crisis to deal with, the bottom of the bear market. We had first quarter down 2.8. Second quarter was even worse than the first quarter by a long shot. In fact, the worst of all midterm election years where there was a down quarter, down 21.3%. Excuse me. And the next 2 quarters were positive, but we ended up seeing a down year, 11.8% decline to 1962. LBJ is first. He's got Vietnam, the beginning of Vietnam. We've got first quarter was down 3.5, then 2 consecutive negative quarters. Market was down 13%. I don't want to go through all of these because there's a lot to look at here, but you get the point. You can hit the pause button. You can look at the rest of these numbers. But what we see here is Nixon, 2.6. Nixon and Ford, down 3.7. Reagan, down 8.6 his first term in office during that midterm election year. Clinton, down 4.4. George W. Bush, first term, down 0.1%. Trump, first term, obviously only term, down 1.2%. I don't know why I said first term. It's ridiculous. Same thing with Biden. I don't want to say first term. I don't think Biden's going to run again. But that's beside the point. Down 4.9. So what's going to happen? With Trump, he had 2 consecutive positive quarters, and then he had a negative fourth quarter, ended up having a down year in 2018. But we can see here, Reagan positive, Clinton negative, Nixon positive, but Nixon and Ford negative. So we're just going to have to kind of see how things go. And I don't think that we can look back at these old numbers and make predictions, especially predictions that are tradable with our money, our real money, based on these historical numbers. What we can do is we can use short term, or we'll call it short to intermediate term, rear view mirror performance that's happening right behind us in our jet stream, if you will, to see what's doing best and to stay invested in the playoff teams. In other words, to stay invested in the relatively strongest investment classes, whether that be asset classes, sectors, industry groups, and so on. And what you're looking at here is an asset class ranking that compares all the major asset classes. I threw an extra one in here in small cap stocks, but what you're looking at is commodities, large cap U.S. stocks, international stocks, cash, small cap U.S. stocks, and bonds. And what's crazy about this chart is that commodities are doing so well that it makes everything else look like it's just kind of sitting back in a pack in the distance in the dust. But number 1 by a long shot is commodities. Number 2 is U.S. large cap stocks. But then number 3, and by the way, this was a week ago that I pulled this chart up, so I apologize. It's a little bit old. But a week ago, international stocks were number 3, and cash, or in other words, 1 to 3 year T-bills, were number 4. But that's flipped now. So cash is actually number 3, and then international stocks are number 4, and then small cap stocks here in the U.S. and bonds in the basement. So that's where we're at right now. Another thing that I like to watch, and I look at this literally daily, this is a chart that takes the S&P 500 up top. There's RSI in the middle here, just in case I want to look for divergences, or whether we're in a bullish or bearish regime, things like that, which don't really matter today. But the biggest thing I look at, and this is one of my mentors taught me years ago to look at this NYAD chart, and what you do is you just draw a line at the negative 2,000 mark. And if we're in an uptrend, whenever we see a drop below that negative 2,000 mark, that usually defines a good entry point, meaning it usually defines a near-term pullback or dip to buy. Now, the problem with it is it only works when we're in an uptrend. And right now, whether we're in an uptrend or a downtrend is debatable. In other words, I would argue that right now we're kind of in a choppy, sideways, trendless market, and I don't really know that we can confidently say that this most recent drop last week to find a good dip to buy, especially with what happened the rest of the week last week, or what needs to happen this next week in order to keep any hope of a short-term trend positive, let alone an intermediate-term trend. Because the market's been choppy. The market can't really kind of figure out whether it wants to stay healthy or not. This is a risk-on versus risk-off indicator. At Sentiment Trader, you have to be a subscriber to see this, but I've subscribed to their research for years. They're wonderful. If you want to check them out, it's sentimenttrader.com. I think that's their website. But anyway, when this indicator is a combination of several different sentiment indicators. I hesitate to say 12. It might even be 16. But when they combine all of them together, what you see is above this 50 mark means risk on. In other words, bullish, good, positive. Below this 50 line means negative, risk off, bearish, not good. And you can see here that while we were pretty positive between, call it November of 2020, I'll even go back to say June, July of 2020, through about July, August, September of 2021, it's kind of been a chop fest since then. It's just been a total mess. In fact, when you take things deeper and you look at the market environment using another indicator, again, this is proprietary to Sentiment Trader, down here, bottom left, Sentiment Trader. Whenever they're looking at 9 different indicators, market environment indicators, and you can see here that whenever we're above 5, it's positive. Below 5, easier for me to say, is negative. And then there's the shaded area up here, and all these shaded areas are times when this indicator in the bottom pane is below 5, and it's just kind of been all over the place, especially this last year or so. And when we look back to 1990, and you invest $10,000, and you invest only when this indicator is at 4 or worse, then you might have turned out about $18,000 going back to 1990. 10,000 turned to 18,000 or so. If you only had it invested at times when this indicator, the sentiment indicator, was at a 5 or higher, so 5 to 9, then you turned out more than $70,000 at the end of the day. So you can see, again, things are a little rough right now, and they've been rough for a little while. So the question is, when are things going to turn around, right? Of course, nobody knows. But how bad are they? We have to look at the evidence. This is another piece of research that I subscribe to, probably one of the best pieces of research that I subscribe to. It's called Lowry Research. They're one of the oldest, I believe, the oldest technical analysis research in the U.S. The upper pane here is the Dow Jones Industrial Average, and you can see that the Dow really hasn't gone anywhere in a really, really long time. It's been up, down, but generally sideways. In fact, this 200-day moving average right here, this slow, smooth line, I would argue is flat to negative. I believe it is sloping negatively right now. Negatively, this red line in the bottom is selling pressure. The black line is buying power. What we want to see is rising buying power above selling pressure, and ideally declining selling pressure. So what we've seen instead, really this past more than 12 months, is this hot mess of choppiness, of this changing control from buying pressure or buying power being in the lead to being below selling pressure, back above it again to below it, but in a downtrend. Then we saw things kind of try to perk up here. Then it went sideways until just this past month, when things really kind of started to perk up, and call it the second week of March. But now, just this past week, even though we saw buying power increasing, we also saw selling pressure increasing. So sellers were also enthusiastically joining the party here, even though buyers were enthusiastic as well. And now just this past week, sellers have again taken over the lead in this leadership battle between bulls and bears, which is not good. It's not the end of the world, but it's not good. And this is something we have to keep watching. Speaking of Lowry, Paul Desmond he passed away a couple of years ago, but he was a mentor of mine. He was the president of Lowry for a long time. He's written several papers. He was what I would call a legend in technical analysis, and he was kind enough to lend me his ear, his email, and his phone number, and we had several conversations, and one of which had a lot to do with Dow Theory. And I'm not going to spend too much time on this, but when it comes to Dow Theory, Charles Dow, or Charlie Dow, if you want to pretend like you're on a first name basis with him, was the godfather, the founder, we'll say, of technical analysis. And if you don't know who Charles Dow is, then if you know the Dow Jones Industrial Average and the Dow Jones Transportation Average, he invented those. So kind of a popular guy, at least in the market anyway. So apologize for my voice, by the way. It's I'm sure it's just going to get worse here as I keep talking late into the evening. But what we see here with the Dow Jones Industrial Average, is we see lower highs. We also see lower lows. And these are major highs. These aren't just this is not a short-term chart. This is an intermediate-term chart. This goes back months, and that's not really good. But more importantly, when we look at the transportation average peaked, or at least its all-time high, was 2 months before the industrial average peaked, which was in December, at the end of December, I should say, of 2021. And now we've seen this lower high in the transportation average, and just this past week, a breakdown. And even though we've had multiple lower lows, we've got a breakdown below that most recent low, the February low, in the transportation average. And what Paul Desmond used to say, and it was just a reiteration of what Charles Dow would say, is that the two major market indices in the transportation index and the industrial index need to confirm one another. So if we're seeing major highs, higher highs, and higher lows, but specifically higher highs in the industrial average, the Dow, then we need those highs to be confirmed by the transportation index in order to be in a true healthy bull market. And right now we're not seeing that confirmation. In fact, we're not only seeing lower highs in the industrial average, but now we're seeing lower highs and a breakdown in lower lows in the transportation index. Now, that's not the end of the world. Again, you look back and you see this huge melt up, which, I can't think of this or see this from October through November as any other way but a melt up. When you go in 1 month, from 14,000 to 17,000, that's a melt up. But it's not the end of the world, especially if we can stay above those October lows, September-October lows. If we can do that, I still think that we're okay. And again, we're in the midterm election year, and midterm election years tend to be choppy, difficult, and bearish, generally speaking, until about October or so. So we have to keep that in mind. Another thing I'm watching is utilities, which is a defensive sector. Typically, when utilities outperform the stock market, meaning the S&P 500, that's more of a risk-off or at least defensive environment. What we really want to see is we want to see the market outperforming utilities, which tells us that the offense has the ball and we can try to score points and we can be aggressive. But right now, instead, what we're seeing again is utilities. When this chart is going down, that means the market is beating utilities, and when it's going up, that means utilities are beating the market. And what we're seeing here is, first of all, this big, huge, flat, horizontal line of potential support and resistance, back in September of 2020, hit that line and bounced, hit it again, bounced in 2021 January, and then it broke through. In other words, we had a breakdown February 2021, which, by the way, was when most of my friends in the technical analysis community would say that the market peaked, was in February of 2021, not in December of 2021. But anyway, this is utilities. The utilities continued to, generally speaking, underperform the market here, right up until we saw November, December peak up. And all of a sudden we start to see not only a rise, higher highs, higher lows in the relationship between utilities and the market, but we see a breakout above this horizontal line of potential, which is now confirmed, resistance above our head, a ceiling of resistance. We get the breakout, and textbook. It pulls back just like oftentimes they do, relationships like this. It retests that line in the sand right there, and then it heads higher again, which is confirmation that this breakout is real, at least for the time being. So we're going to have to watch this again in the construct of all the other evidence that we can look at in the market and see, are we in a healthy, positive environment for stocks? Are we in a trendless environment for stocks that's kind of going nowhere? Or are we in a unhealthy market where things are not going well and we need to be really, really careful and perhaps raise cash in our tactical models. I'm really sorry that I'm so stuffed up here. But anyway, moving on, I'm going to keep going and push through my voice. This is small caps. We've got small caps by the IJR ETF, small cap 600. And you can see that going all the way back to the beginning of 2021, that it just hasn't gone anywhere. Small cap 600 hasn't gone anywhere. It just kind of keeps hitting this bottom, potential floor of support over and over and over again. And good news, it doesn't seem to break through it. Bad news, it's kind of stuck between its 200-day moving average, which is the red shaded area, and then this floor of support here in the black dashed line. On the other hand, when we look at another representation of the small cap index, instead of the small cap 600, we're looking at the Russell 2000, which is also a small cap index. The difference, as you can see here, obviously more stocks, but the difference is we hit this floor of support several times, but then there was a breakdown below that support in early 2022, and then the market just kind of chopped sideways since then. So it keeps trying to get back to that line in the sand and recover, but it just hasn't been able to do it. When we look at the stock market in general, these are volume-weighted average price from March 15th, the most recent low, and then we've got the volume-weighted average price from just a couple weeks ago. And then you can see how there's this squeeze occurring. The volume-weighted average price is the average price at which an investor purchased in this case the market, or the SPY, since March 15th, and then again here going back a couple weeks. And so anybody above that line is a winner, and the average person, if it's below that line, if the market's below that line, then the average investor is a loser below that number. So these are important levels to pay attention to. And when we compare those two lines to the most recent low, call it a short-term low from a couple weeks ago, call it 3 weeks ago, I think that we got to pay attention to this line in the sand in the short term. If we break this line, I think we probably retest these lows down here at 420, 418 on the SPY. And then my friend Brian Shannon, who did a wonderful video and really was the inspiration for this chart, he can be found on Twitter at Alpha Trends. His website is alphatrends.net. He is the architect of the VWAP, the volume-weighted average price. He invented it. Good friend of mine, great guy, amazing analyst. Got great short-term analysis. If you're interested in checking him out, I definitely would if I were you. But you can see here's the year-to-date volume-weighted average price, which at least for now, the average market participant who invested on January 3rd, the beginning of the year, is technically winning. So that's just one more reason why this most recent low and these other lines in the sand I think are really, really important. So in a perfect world for the bulls, what I would like to see is for the market to hold this low, hold this VWAP level, and for the market to kind of chop sideways and then head higher from here. All right, well, I'm going to keep going here. I need to stop recording these so late at night. I think that's probably why I'm losing my voice. But anyway, another look at the stock market, S&P 500. We've got the 10-week moving average here in blue, which is always important. I think it's more of a short to intermediate term, but really on the shorter end of the trend following spectrum. Then we have the 40-week moving average, which is pretty much the same as the 200-day moving average. And that's what we're looking at here in the bottom, that smoother line. 40-week moving average is still technically sloping up. We saw a close below it to start the year. Kind of a risk-off environment. We see a cross of the 10-week below the 40-week, which doesn't really mean anything to me at all, by the way, but just an observation, which you could argue is bearish. But I think that crossovers like these can be lagging and can get you into trouble if you follow those as signals. So in other words, if you would have sold there, you would have sold either this week here or the week after, and then you've been out at the bottom or near the bottom anyway. And then here, the market's starting to recover, and if things don't get much worse, if this Russian invasion of Ukraine was the bottom, then that's what it was, and you missed out, or at least you're missing out until this thing crosses back over. So I wouldn't use a 10 over 40 work week as a signal on its own. But all that being said, I'm not trying to give advice to everybody who listens to this video or watches this video either. So you've got to do what works for you. It makes the most sense for you. Like I mentioned, the 40-week moving average is about the same as the 200-day moving average. There is, I don't know who originally said it, but there's a famous market technician who said that nothing good happens below the 200-day moving average. It might have even been Bill O'Neill, I can't remember, but here this red shaded area is the 200-day moving average, and if that holds true, then as long as the market is below that red shaded area, then one could argue that nothing good happens below that red shaded area. The thing is, the market's not just the market, right? There's a bunch of stocks in the market, so we're not just looking at the market, but we're looking at many, many, many different types of stocks, commodities, bonds, and so on. And we'll get into that. Last thing I want to show you in the market itself, or at least a market chart, is just kind of some lines in the sand that I drew. We've got, right now, we're kind of stuck between that short-term low, like I said. We had the market break out above its most recent highs, which is good, because right now you could argue we've got a higher high in place. In a perfect world, we stay above the short-term low, but even if we don't, it's just a short-term low, and that's all. And we could head down a little while longer here, and that would be healthy. It would be okay. But as long as we stay above 4170 or so on the S&P 500, we can still print, we can still see, I don't use the word print, we can still see a higher low than this low, and then we can see a higher high, and the market could take off from there. But again, I know I'm going to say this a million times, but we're in a midterm election year, and the market's going to take a little bit longer, I think, than usual because of the fact that we're in a midterm election year, the uncertainty between now and the election before we see any really, really bullish activity. Now, if we were to lose this 4170 line in the sand, then the next line in the sand here would be about 4060 or so, going back to the May 2021 lows. So that's what I'm looking at. These are the levels I'm paying attention to. We've got a little bit of cash raised in our tactical models across the board, something in the ballpark of 15 to 20% or so in cash raised. But otherwise, I'm not seeing this as tornado sirens just yet. My good friend Andrew Thrasher sent this out in his weekly market letter. I thought it was really good, worth sharing with you. As the market's been kind of declining here, what we're starting to see is an increase in 52-week highs of the stocks within the stock market. So one of our clients asked us this past week, are we starting to see internals improve, breadth improve? I believe the specific question he asked was, which we'll get to on the next slide, is, are we still seeing that bifurcation that we saw in the 2021 market? Now, first of all, I can tell you that we're seeing an increase in 52-week highs, 6-month highs, 3-month highs, and 20-day highs. I like to use 21, but here we have 20-day highs. Now, most recently, these kind of dropped a little bit as the market fell late last week, and that's okay. But, this is generally positive news. 20 days not important to me as the 6-month highs are, and especially 52-week highs. So up here, this is what's important. But evidence tells us we're starting to see new highs across the board here. That's good. As far as bifurcation goes, first of all, Apple just recently 7.1% of the S&P 500, and the S&P 500 is 508 stocks, I believe. So to have Apple represent 7%, and it's just one stock, that's big. You can see going back in time, Exxon used to be the biggest at 5%, Microsoft at 5%, and at one point, back in 1985, we had IBM at 6.4%. But right now, I believe, if memory serves me right, the top 5 stocks in the S&P 500 still make up about 24% of the index, which is a pretty big number. So first of all, as far as bifurcation goes, we are still seeing a lot of strength out of the large and mega cap names relative to the mid cap and small cap names or stocks. And specifically, again, this is Andrew Thrasher, his chart, not mine. But I thought it was really, really good, and I loved how concise it was, so I thought I'd borrow it here. But you can see here that we're getting 6-month highs, higher 6-month highs, just this past week even, in the large cap stocks. The big, huge mega caps, the generals. When we go down here into the troops, the privates, sergeants, small caps, mid caps, we're seeing lower lows. I'm sorry, we're seeing lower, the percentage of stocks hitting 6-month highs, we're seeing lower numbers. So that bifurcation still exists, which is why at our office anyway, we are overweighting the large cap and mega cap space for the time being when we're in stocks, even in our tactical models, for that very reason. Now, I want to change gears. I could spend an entire 30-minute podcast or screencast just talking about this right here, bonds. I can't believe we're seeing this, but in since July of 2020, so it's been a while now, but since summer of 2020, the U.S. bond market, as measured by BND, or the Vanguard Total Bond Market Index, the U.S. bond market is down over 13% as of Friday, which is terrible, obviously. When I'll go a little bit further here, corporate bonds, as measured by Vanguard's long-term corporate bond ETF, are down almost 21% since summer of 2020. Go a bit further, TLT, so the 20-year Treasury bond. This is United States Treasury bonds, are down more than 27% since the summer of 2020. When I analyze the 20-year Treasury a little bit more, I pulled this up just when I was tinkering around and building this PowerPoint here for you today. It's sitting right now. The prices are below this past week. The price of 20-year Treasury bonds dropped below prices in 2016, 5 years ago, and it's just not good for a number of reasons. I'll show you one more. This is 25-year zero coupon bonds. The ETF is ZROZ, and zeros are down more than 33% since summer of 2020. And the reason why this is so important, and I hesitate to use the word sad, but it's frustrating for sure. And I think sad for many conservative investors, because we've been taught in this country for years and years and years that bonds are safe. And if the stock market doesn't do well, then that's why you want to have bonds in your portfolio. In fact, if you're an aggressive portfolio, don't worry about bonds. Don't invest in them. You're fine. You got time, right? Or you're an aggressive investor, whatever. But if you're a balanced investor, then you should put 60%. I'm not saying this, but I'm saying the industry has taught us that you should put 60% into stocks and 40% into bonds. And if you're a conservative investor, so if you really are risk averse, then you don't want to have any more than 30 to 40% of your money in stocks, 40, 45% at most, because you don't want to take too much risk. And instead, that other money, 50, 55, 60%, should be in bonds. And if you're a conservative investor and you're looking, and I'll fly through these real quick here again, one more time. Bond market in the U.S. down 13. Bonds, corporate bonds, down 21. 20-year Treasury bonds, down 27. 25 years, zero coupon bonds, down 33.5%. How in the world can you feel like you're conservative if you own stuff like this? And if you're somebody watching this video and you're wondering, okay, that's fine, Adam, that's great, but what are you doing? I'll be honest with you, we don't own any bonds. We owned some Treasury inflation protected securities into the late part of 2021. We owned some short-term Treasuries into the late part of 2021. But all we own right now are ultra short-term U.S. Treasuries, basically money market. So stuff that is just paying a small interest rate, but it won't generally lose any money. So we're not so concerned about making anything. We're more concerned with just not losing anything in the bond sleeve of our portfolios. And then the other thing I've done is I've taken a piece or a percentage of the bond sleeve or the bond allocation in our portfolios, and I've underweighted bonds and overweighted commodities or U.S. stocks, or both, because that's what's making money right now, as you could see from the asset class ranking earlier. And not to throw salt on a wound here, but here is the seasonality, or in other words, the average performance during an average year for 30-year treasuries, 30-year treasury yield. So the yield tends to increase between January and the end of April, and then yields have a tendency to decrease from the end of April through the end of the year. So here's the big question with bonds. If seasonality, or if the market this year, the bond market, follows this seasonality clock, or this average seasonality, then what we would see is that yields would start to peak sometime in the next 4 weeks or so, 4 to 5 weeks, and then start to decline. And as yields peak and start to decline, what we would start to see bonds doing better. We would start to see bonds increase over the course of the remainder of the year, if things are to follow this chart right here. Because remember, interest rates and bonds are inversely related. In other words, when I say interest rates, that means yields. So since this treasury yield typically goes up and then typically goes down from May through the end of the year, if yields do go down, then prices of bonds would go up, if that makes sense. So obviously time will tell. We're just going to have to see, but this is something I'm paying attention to. Speaking of things I'm paying attention to, fund flows. This is from my friend JC Peretz over at All Star Charts. He pulled this chart up. I thought it was interesting, primarily because this past year, since January 2022, we see this decline in bonds. So in other words, we're seeing fund flows and bonds decrease here, just like we did in during COVID. So recently, we're seeing an increase or an uptick in bonds, but stocks, look at this. Fund flows into stocks, pretty static. I mean, you could draw an average here and say that we're right about average, if not a little bit, above average. But fund flows going into stocks, still holding steady. Fund flows into commodities, looking really good. When I say good, I don't mean good versus bad, but positive. So we're seeing positive fund flows into commodities, and a lot of that's due to inflation, and really, honestly, commodities doing well. And when I say commodities, by the way, I mean oil, energy, gasoline, natural gas, palladium, platinum, nickel, grains like soybean, corns, wheat, gold, silver. All of those things are commodities. So that's what we're talking about when we say commodities. All right. Last section here I want to go through with you. Sorry, that was a little loud. Last section I want to go through with you here is some individual stocks. Some of them we own in our strategic models. Some of them we own in our tactical models. But there are some we don't own in our tactical models. Qualcomm being one of them. We own the Qualcomm in our strategic models, but we sold it out of our tactical models after it started to break down below its 40-week moving average. So we've bought and sold this twice, actually, recently, as it's been whipsawed here. The 200-day moving average is what you're looking at. I use the 40-week moving average, which is pretty much, like I said earlier, the same thing. Next, we're looking at Marvel. or Marvell. I'm not sure if that's the right way to say it. Marvell's been a good stock. It's been positive. It's been trending, but it's been choppy lately, just like Qualcomm. Not quite as bad, but still choppy nonetheless. And if we can't see Marvell perk up here in the near term, while it's still relatively one of the better stocks in the market, if we're in a downtrend, we're not going to own it in our tactical models, but we will still own it in our strategic models. Because again, even in a strategic model, we're still going to want to own the strongest stocks, even if they're going down on an absolute basis. Next one I want to look at is Nvidia. Also choppy. Nvidia just closed below its 40-week moving average last week. You can see here it's below its 200-day moving average. Great stock. Semiconductors are obviously under huge demand with very little supply. But if the stock price isn't going up, that's not good. So we'll have to see what happens this next week, really tomorrow with Nvidia, Marvell, and whether or not we're going to own those or not coming into the new week, depending on how it does tomorrow and whether it can recapture its 40-week moving average. Same goes for Google. If Google can't recapture its 40-week moving average, here's its 200-day right here, then we're not going to own it in our tactical models. But again, we'll still own it in our strategic models because, relatively speaking, it still looks like a great stock. Much longer term for those of us who are in our strategic models. Strategic, easier for me to say. Apple. We own Apple in our strategic and tactical models. Looks great. Real no complaints here. A little bit of choppiness, but still positive. Next stock here is Broadcom. Broadcom is still looking healthy. Higher highs, higher lows for the most part, with the exception of this high in December. Got a lower high here, but we've still got higher lows on the bottom of the chart here, and we're clearly, healthily above our 40-week moving average, above the 200-day moving average. Dollar Tree looks great. Higher highs, higher lows, and just blowing its 200-day moving average out of the water. Same with its 40-week moving average. So again, no reason to worry about this stock, at least for now anyway. Exelon just kind of like Dollar Tree, but even better. This stock, higher highs, higher lows. This is the definition of an uptrend. Very, very healthy, good looking stock. O'Reilly, O'Reilly, looking good. Kind of was chopping sideways here for a while. Saw some lower highs, saw some lower lows, or at least equal lows. And then we kind of saw it build a little smiley face here. If you draw a U underneath these lows, and then a breakout above its December high here. A nice, big, high volume breakout, which is good. That's what we want to see out of a healthy stock. Next one here is Palo Alto Networks. Also healthy stock, with the exception of this lower low here in February. We still saw a big 2-day climb in late February, a breakout, pullback, and another nice run into new all-time highs. Now we're just digesting those gains, and my assumption is this will probably resume its trend higher from here if it stays healthy, of course. And next, we've got commodities. I've been talking a lot about commodities. I wanted to annotate this chart, and I apologize I didn't. What you see here is a symmetrical triangle. Sorry about my speech here. I feel so stuffed up. I'm losing my voice, but a symmetrical triangle, easy for me to say. So we have a symmetrical triangle. We've got down, up, down, up. I mean, that's 1, 2, 3, 4 touches on either side of the triangle. If I were to draw lines at the bottom and top here, we'd be close to our apex. Most triangles break out or break down roughly 3/4 of the way through the apex. So we're right about there at this point. And usually the breakout or breakdown takes place in the direction of the primary trend. And if you look back in time, the primary trend is positive, not negative. So this should break out positive, or in other words, break out to the upside, not break down to the downside, which would make sense, of course, fundamentally. We got the inflation issues we have in the market right now. We've got gas prices going up, oil prices, gold, commodity prices rising, so that would make sense if it continued to climb. Another thing to pay attention to here, by the way, which I find really interesting, is copper. Copper just broke out of multi-year highs, and I want to draw your attention to the bottom of the screen here. This is not a short-term chart I'm showing you. This is a multi-year chart. And copper, unless it's losing its characteristic as a leading indicator of the economy, we're seeing copper break out of its 2010 highs to all-time highs. If copper can hold above this line in the sand here, this potential line of or ceiling of resistance, then I have a hard time believing we're going to see a recession in this country. So some of this stuff that I've shown you today is bad news. Some of the stuff I've shown you so far is good news. Some is flat, neutral news. But we have to build a case for what the evidence is telling us and build a case for what the market looks like as a whole. And what I see so far is that we do have higher inflation. We do have higher, strong commodities, which is good, if you own commodities, of course, which we do. We've got a kind of a stock market that went through a big correction, and now it's just kind of deciding whether or not it wants to head higher yet or not. But we're in a midterm election year, and it just, the probabilities say that we really won't see any kind of strong trend to the upside till probably closer to the end of the year. In other words, kind of a chop fest until then. But there's still a lot of good news out there, and I guess I want to touch on some more of that. This is again Sentiment Trader. I've heard a couple people say, "Well, the yield curve." We had a client send us some, frankly, what I would call BS. This article that they wrote, or I don't even know if it was an article. It was just a call on the market saying that whenever the yield curve inverts, that we're going to see a recession. And by the way, a recession is based on the economy, not the stock market. In order to go into a recession, we have to see two consecutive quarters of negative GDP. And in order to confirm two negative quarters of negative GDP, it takes a third quarter to confirm the first quarter's numbers and a fourth quarter to confirm the second. And then the average recession doesn't really last much longer than a year, which means that by the time we're in a recession and we've confirmed it, we're already almost out of it. So I would pay less attention to recessions and more attention to stocks and stock prices. But that being said, you can see here, this is an indicator used by Sentiment Trader. Again, shaded areas are recession, and then down in the bottom here is the percentage of U.S. Treasury yield curves inverted, because there's more than one. There's several different yield curves when you compare different yields and durations. And down here, when you look at the average, we're not really seeing a big, huge jump in yield curve inversions like some would like you to believe. And you can see here the average return of the S&P 500 when this indicator is below 25% is 10.2. And it's below 25%, 85% of the time. So all this fear, let's go back. I mean, do I have to go back to our quote of the day at the beginning of the day? All this fear is meant to scare you. It's meant to keep you out of stocks. So another Sentiment Trader chart here is the average yield curve is still positive. In fact, it might be kind of consolidating here, and chopping sideways, but it's definitely not trending down. It's either trending sideways or trending up, one of the two. But I don't see this in a downtrend. And you can see every time going back to the 70s, you can see here 1970, 71, 72. When we had that recession in the early 70s, is when you've got the average, or in this case the median U.S. Treasury yield curve below zero and curling up, and that's when you'd see your recessions. And we're not seeing that now. It's just factually not happening. Some more positive news. This is from Macro Charts. I follow him on Twitter. Great analysis, great charts. I don't pay close attention to a lot of other technicians on Twitter, but I've got a handful in a list that I keep, and this is one of the Macro Charts is one of them, and this is going all the way back to before the .com bubble. This is the NASDAQ, by the way. And you can see here, every time we've seen an advanced decline bread thrust in the NASDAQ, a 10-day bread thrust, he's marked it here. And those have generally been times when the market went up following those bread thrusts. So that's one. The other one I wanted to show you is Martin Zweig or Marty Zweig. Here's a bread thrust on the NASDAQ 100, so top 100 stocks of the NASDAQ. And you can see here, Zweig bread thrust on the NASDAQ 100 just triggered March 18th. And these are the historical returns after past signals since 1997, since 1997 we've seen 2 crashes, arguably 3, depending on your definition. But the average return after a Marty Zweig bread thrust on the NASDAQ 100, 1 month later is 2.5%, 2 months later 3.9%, 3 months later 6% almost, 6 months later market's up. When I say the market, the NASDAQ 100 is up 11.6%, and 89% of the time it's positive. 1 year later, 20% almost, 91% of the time it's positive. Average drawdown during the period, in other words, average decline, anywhere between 2.5% to 6.5%. Call it a temporary decline because that's exactly what it is. And then the average max gain, anywhere between 4.5% to 26%, almost 27%. So, again, just showing you some good news here, some good things that are happening. Just got to be patient. This is the AAIM or AAIM. I think I'm saying that right. Average bull bear spread. This might look bad, but going back to 1987, this is the most bearish people have been, and that is a contrarian indicator. When we've got lots of bears, lots of negative sentiment. And again, if you don't remember, the reason they call them bear markets is because bears attack with their claws from the top down. The reason they call them bull markets is because bulls attack with their horns from the bottom up. And so when we have a lot of bears, a lot of people who are pessimistic on the market, once that last bear jumps on the pile and there's no bears left, then all it's left to do is for the market to go up. And to make matters worse, for the bears anyway, is if for those who've shorted the market, those shorts start to get squeezed, causing additional upside participation and pressure in the market. All right, I've got 2 more slides left before I completely lose my voice. This is, again, macro charts. This is total U.S. equity futures positioning in a 5-week net change. This was a huge changes. These are big changes that have happened over history because, again, this goes back to the peak of the market .com bubble, and there's only been 1, 2, 3, 4, 5, 6 times now that this has occurred. And you can see the first time the market went up for looks like about 9-10 months before it ultimately peaked and then headed down for the Great Recession mortgage crisis. Second time, market went up. Third time, market went up. Fourth time, 2018, market went up. Fourth time after COVID, market went up. And here we are. So this is a small sample size, right? There's only 6 in this sample. But obviously a wildly bullish piece of evidence. And then the last one I want to show you today, I think I've shown our clients this in meetings. This is Ryan Dietrich, my friend, head of technical analysis at LPL Financial. When you go back to 1950, at every time we've had an intra-year pullback or correction in the market, or crash for that matter, 1950 to present, the average drop, 17%. The average return 1 year later, 32%. I don't like to look at averages because of the joke I always love to tell about the guy who drowned in a river that was an average of 4 feet deep. If you're looking for a punchline, that's it. There is no punchline. That's the joke. If you laughed at it, thank you. If you didn't, then rewind, try again, and maybe it's just not funny. 1978, market bottom went up 11.3%, obviously. A rise of 11.3 after a bottom of 13.6 is not back to even. 2014, market went down 7.4, then went up 8.7, closed in the green. But so I always like to look at the tails, I guess, so the anomalies. But the point is that when we see these drops, midterm election years tend to have pretty big intra-year drops. They also have a tendency to have the biggest bounces. And the average date here, I put a little bubble down here as well, but the average date for when the market bottoms is August 14th, with the median being September 4th. And the reason why I think that's important and a great way to end today's video is because, again, we have no idea when this volatility is going to calm down, but it's a volatile time. It's temporary. If it turns into something worse, our tactical portfolio models, the tornado sirens will go off, and we'll head to the basement. Our strategic models have already rotated into many defensive positions versus offensive positions, and they'll continue to do that. If the market continues to get worse, we're going to own almost nothing but defensive names. I'm sure of it. So if things get worse, then we'll position ourselves in that way. If they don't get worse, if they kind of flatten out, if the market bottoms this year somewhere around August 14th, September 4th, or if we've already seen the bottom in the market, and we're just going to chop sideways for a while, or at least just if the market's just going to be choppy and kind of a hot mess through summer, still things will be fine through the end of the year. It's just a matter, again, of paying attention, making sure you're allocated in the right types of investments, the right allocation, and the right percentages for you. And then if you're somebody who's interested in having a portion, let alone all, of your money invested in a tactical portfolio model, a trend following model, in other words, then there's that extra layer of protection that, if the market's fast, meaning if it goes down fast and comes back fast, then the trend following models are going to struggle. But the strategic models that stay in the market, whether that be in offensive or defensive names, are going to do well in those fast markets. But if the market goes through a low, slow, grinding bear market that lasts 6, 12, 18 months, those tactical models are probably going to shine. And while the strategic models may not perform as well as the tactical models, because they're invested in defensive names, because there's that asset class, sector rotation, industry group rotation, the goal will be, again, to stay invested in the playoff teams, avoiding the rest, staying with strength, and avoiding weak players in the market, so as to, even if the market's going down on an absolute basis, then on a relative basis, the goal will be to outperform. So with that all being said, I'm going to close out for today. If you have any questions for me personally, please feel free to reach out. You can email us at info@libertaswealth.com. If you'd like to set up an intro call with me, you can do so on our website as well. You can send us an email, a form message, or you can literally just set up an intro call if you'd like. If you'd like a second opinion on your portfolio, a second opinion on your financial plan, please reach out and let us know. We'd love to have a chat with you and just get to know each other better and see if it might make sense to go through our second opinion process. And feel free to follow me on Twitter at Adam Koch. Our company Twitter page is LibertasWM. I'm on Instagram at Financial Surgeon, and we're on Facebook at facebook.com/Libertas Wealth. That's all I've got for today. So I hope you enjoyed today's longer than usual, but hopefully somewhat interesting, nerdy quarterly scouting report for the second quarter of 2022, and I'll look forward to seeing you soon.